All right, what's up, everybody? It is Tuesday, December 20th. We got 5 days until Christmas, Krista Magoo. And happy Hanukkah. It's the second night of Hanukkah to all my Jewish friends. So the big news today, the big news was a very unexpected shift in monetary policy by the Bank of Japan. You know, I've been giving a lot of kudos to the Bank of Japan recently because I said they're the only central bank in the whole entire world that has kind of bucked the trend of, you know, hysterical rate increases. And I've also, spoken about the fact that because the Bank of Japan has kept rates negative, Japan has not really experienced the kind of inflation that one would think, because the country is totally reliant on imported oil and inflation is still very low there. And a lot of that has to do with their discipline on monetary policy and not, following this insane approach of all these other central banks led by the Federal Reserve, jacking up rates, which just continues to raise the price level broadly. Like the general price level, it just keeps going up with these rate hikes. But the Bank of Japan has been very disciplined and steadfast until today. And the move wasn't a big move, but it was the first time we have seen a shift in policy in a number of years. So basically the Bank of Japan widened its acceptable band for the 10-year government bond. Now they're saying they'll let it go to 0.5% from 0.25%. Not a big deal, of course. We're talking about, minute rate levels, but it was taken as a shift. It was a surprise. It was looked upon as a shift in monetary policy, a change in stance, if you will, and definitely surprised the market. And it gave a jolt to the yen. The yen was up like 4%, 4.5%. Big move. That's a big move for a daily move in currency markets, especially for, a major currency. We're not talking about like the Turkish lira or Argentine peso or something like that. I mean, it's the yen after all. So that was interesting. There's not too much I can add to that. I do think that the yen's move higher is going to continue, and I'm mostly I'm thinking against the dollar, because I do believe that the dollar now, we're entering into a period, as I've been talking about, where in 2023, and even starting now, we're going to see a fiscal expansion, and it is going to be, I think, pretty long term, because, when you look at, again, the increases in interest income flows, when you look at next year's increases in Social Security benefits, they're going to be significant. So I think the dollar is going to reflect that with a weaker tone. The only thing I would say that might offset that to some degree, and I have mentioned this, is the fact that the U.S. is becoming a major petroleum export country. And that's bullish for the dollar. So I mean, monetary factors, the fiscal expansion, I think that will be negative for the dollar, but there will be an underlying bid because of the fact, or due to the fact, that the U.S. is a net exporter of petroleum. But we'll see how that plays out. I'll just tell you right now, I'm short the dollar, and if we get rallies, I sell into that right now. And I might take a look at it again by mid-March of 2023, but right now I think that the dollar is going down, and I think with this move by the Bank of Japan, that's just going to trigger a lot of zombie buying of yen. So, because that's how the zombies think. They're completely monetarist in their thinking, and that's why, we saw that today and how it played out, right? I mean, they did this minute little shift in their policy stance, and boom, the yen shot way up. So let's talk a little bit. So yesterday we had another tax drain of 14.8 billion, almost 15 billion, which brings the 3-day drain. That's last Thursday. Thursday, of course, was the quarterly corporate tax payment. Friday, and then yesterday, that's 85.7 billion. So that's pretty close. You know, I said it was going to be around 90 billion. It's pretty close to what I was anticipating. And I think that we have just seen, or that was the optimal, this last few days sell-off in the market. What did we have? We had like 5 days down, right? I spoke about this yesterday. Today was an up day, by the way, which I think we'll probably see that today's flows were net positive. Tomorrow, by the way, we get a Social Security payment, so that's going to be a net positive. So I think, you know, we're pulling out of this this correction that we had since the tax drain. But it looks like those 3 days, last Thursday, Friday, and Monday, were the optimal window for buying the dip. That doesn't mean you can't buy anymore. It just means, like, if you were looking for, and I tell you all this in advance, all right? I told you about the December 15th tax payment. I told you that we're going to do about a 90 billion drain, with so far 85.7 billion. I said that's going to, you know, it's going to pass through the system, and then the normal course of spending is going to recycle that back into the economy, and we'll get a positive tone. I think today was the start of the positive tone. Tomorrow we get a Social Security payment, and, you know, the cycle begins again. So I think the last 3 days, Thursday of last week, Friday of last week, and Monday, that was the optimal window. Okay, those were your weakest days, culminating in yesterday's low. All right, so we'll see. But I do think that was probably the area. Now, like I said, it doesn't mean you can't buy. It just means that I think now the picture starts to turn positive. Now, of course, there's going to be a lot of resistance to this positive view, because overwhelmingly, I just saw a thing today, and in fact, I'll put up the headline here, that economists are saying there is a 70% chance of recession in 2023, to which I say there is I'm going to say there's a 95% chance that there won't be a recession. Okay, so I'm going against, it's little old me going against all, you know, these economists out there who are all pretty much in unison, overwhelmingly saying there's going to be a recession in 2023. And I've spelled out my reasons why I think there's not going to be a recession. And again, I'll just go over it. You know, massive interest income transfers thanks to the Fed, increases in the cost of living, increases in Social Security and these other things, defense, lots of big spending. As a matter of fact, Congress just they just passed a big spending bill, but I don't know. I don't think that's still a done deal. The only thing I would say, and I said this yesterday, is the debt ceiling. That has to be raised, because if that's not raised, then it puts a limit on what the government can spend, and it goes into, you know, if it stays under the debt limit, you know, if you don't get that raised for a period of time, then you're basically dealing with like an austerity kind of situation. And if that happens, that's my 5%. So I said 95%, we're not going to have a recession. But if they don't raise that debt ceiling, and if this, standoff persists for a long period of time, then you basically get into like an austerity type of an environment. And yeah, then we're going to have a recession. All right, so it's really up to that at this point. But yesterday I said I still think they're going to do it. I mean, they're passing this funding bill, or at least they're trying to pass this funding bill. They just gave a big raise to the military. They're giving more money to Ukraine. I mean, they want to get all this stuff done, so they're going to have to raise it. I don't see any way around it. So they're going to have to work something out. Anyway, So I'm not that worried about it. But that's my 5%. You know, if the debt ceiling isn't raised and if that standoff persists for a long time, then we go into an austerity situation, and yes, we're going to have a recession. But I don't think that's going to happen. So that's where we are. And again, these patterns now, and somebody said, you know, Mike, I don't think there's a one-to-one relationship between the flows and the market. And I would totally agree to that. I mean, if there was a one-to-one relationship and it was ironclad and it was like axiomatic, like we knew it, like, you know, if a dollar goes in and the market goes up X, we'd all be gazillionaires. Like, you know, we'd own the world in a week. But it's not like that. However, I have to say that it's the best leading indicator that you can stay focused on. It is the first derivative of everything. And again, I mean, you don't have to listen to me. You don't have to follow what I say. It's up to you. You could do whatever you want. You could be a monetarist. You could be a chartist. You could do whatever you want. But I mean, I'm sitting here. I give you exact dates. I tell you what's going to happen. And it's not like dates like I'm looking in a crystal ball, or I have some chart and I draw a line out to something and it happens to intersect with some particular date or some cockamamie ratio 618 or something. No, I say, well, on this day, you're going to have 90 billion taken out of the economy. I mean, it's just going to drain things out. I mean, it's just pure logic. Draining the swimming pool. And on this day, you know, you're going to have a quarterly interest payment that's going to pump a lot of water into the swimming pool. I mean, these things are all playable, and not just in stocks. Like I play them in Forex. You could play them in the futures markets. You could play them with options. And the cool thing about it is, like, nobody's looking at this stuff. People are looking at, you know, arcane things like there's been a lot of talk in recent days about banks borrowing at the Fed's discount window. And, you know, like, the thing that cracks me up about all these stories is that, you know, there's always some kind of background, sinister meaning that is kind of woven into these stories. Like, something's going down, something bad is about to happen. There's you know, the pressure's building, the liquidity, you know. A lot of times all this is just technical. It's like, I mean, and people get into these, you know, these conspiracy theories about something bad's happening because a couple of banks went to the discount window. You know, like, I could say the same thing last week. Every week on Friday, as you know, I put out well, I don't put them out on this channel, but I put them out for my subscribers. I break down the numbers from the Fed's H8 weekly release, which is the banking data release. So last week I'm looking over the numbers and I'm like, wow, these numbers really jumped up. I mean, there were huge increases in bank purchases of securities, you know, Treasury, agency securities, mortgage-backed. I mean, it was really big. And I'm like, wow, look at this. And there was huge increases in loans, right? And I'm like, oh boy, what the heck is going on? Now, if you just were looking at those numbers, you would think, like, man, some kind of tsunami of credit creation and banks, you know. But there was a footnote that the Fed had on its page that said, hey, you know, the reason for the big you know, change in the data was that there was a thrift institution that converted into a commercial bank. So all the assets of that thrift institution now went into that H8 report. Okay, and it skewed everything with these big jumps. But if you hadn't looked at, you know, the footnote and you just looked at the numbers, you'd be like, wow, what the heck is going on? Like, this is unbelievable. So I think a lot of that explains, like, all the chatter about, oh, they're borrowing at the discount window, something bad might be happening, something bad might be happening. It's not. I mean, it's like, there's nothing to see here, folks. Let's move on, okay? So, for example, you're not seeing anything in the Fed swap lines with any kind of squeeze going on in terms of dollar liquidity of foreign institutions or anything else like that. Furthermore, we've had like a few weeks in a row now of the increase in the reverse repo facility. So like deposits are coming in, reserves are coming in to the degree now that the banks again are just like shunting them off to the reverse repo facility. So it's like there's not a to try to suggest that there's some kind of liquidity crisis brewing when in the last 3 weeks we had, I got to look at how many billions now just like, shoveled off into that reverse repo facility. It's like they don't even want those reserves right now. For the last 3 weeks, they were sticking them into that reverse repo facility. So, I mean, you got to look at the details. You got to look at the details. And that's, that's another thing you have to be careful about when you read these headlines. And I'm telling you, if you go to places like Zero Hedge, or if you go to like CNBC and you read the headlines, or if you listen to them, it's always sensationalized. And they don't know. They just don't know what they're talking about, man. They just don't know. Somebody asked me in a comment here that Nouriel Roubini, Dr. Doom, that economist, calls himself an economist anyway, like he just came out with a book or something like, there's a whole bunch of deadly threats to the world, or whatever financial system. He says one of them is the debt crisis, right? Whenever people talk about the debt crisis, the thing is, you never hear them like being precise about it. Like, are you talking about sovereign debt? Are you talking about private debt? Like, what debt what debt are you talking about exactly? You're talking about sovereign debt, and if you're talking about the United States, there is no debt. I mean, I've been over this like a zillion times. I mean, the United States operates in its own currency, of which it's the monopoly issuer. The outstanding so-called debt, 32 trillion in treasuries, are dollars that are held by the non-government worldwide, and they're held in the form of government securities, which basically are dollars. They're just dollars in a different form. That's all the dollars spent minus all the dollars removed from taxation. And those are basically untaxed dollars, 32 trillion that the world holds on account in the form of treasuries or government securities. I mean, it's not borrowing. That is not borrowing. And again, I've been through this whole thing, like you can't borrow until the money's put there. Like there has to be something to borrow, right? You can't drain. Anytime you get into these conversations, you just hit them with, you can't drain the swimming pool until you fill it up first. Okay, if there's nothing in the swimming pool, you can't drain it. And then the other person say, okay, well, what do you mean? Like, the government supplies the water to the swimming pool, okay? It's the only one that produces the water. It's got to put the water in before it could tax it or before it could, exchange it for government securities. It's got to put the water in. So the water, in this case, that's a metaphor for the dollar. It has to put the dollars into the system, into the global economy before it could take anything back, even $1 in tax. It has to first pump it out there, those dollars, to be able to take it back, because that's the only place it comes from. All right? So anyway, that's it. I think the last 3 days, that was the optimal window. We'll see if I'm right, but I expect to see positive flow tomorrow with the Social Security payment. There's another payment next week on the 28th. And then, we get into January. In February, you got a quarterly interest payment. It's going to be like 50 billion. February is going to be a big month. If you're trading this, you might want to, and this rally comes, you might want to take profits in sometime in mid-February. And look for a pullback into March, April. Those are the months that start to hit. Because March, you get a quarterly corporate tax payment again. April 15th, of course, the dreaded April 15th tax day. And, that runs all the way through into a good portion of May. you know, I could tell you the whole year. Like I could basically plan out the whole year. But if they don't raise the debt ceiling, and if that persists, if that situation persists, and we get into like an austerity kind of budget, then yeah, that's when that's my 5% risk that we'll have a recession. But other than that, you know, let it be known right here that I'm going against, and I'm betting big right now, I'm going against all these economists who say there's like 70, 80% chance of a recession next year. Not going to happen, folks. Not going to happen. Bye.